If you've ever felt like you're doing everything right, and yet you're still falling behind, then this one's for you. If money feels confusing or stacked against you, I'm about to make it simple, because if you've ever wondered how the wealthy always seem to get ahead, you're gonna love what I'm about to tell you, because there's only one shift, and that one shift can change everything about how money grows and how money works for you. One shift that puts you back in control instead of putting the banks in control. And once you see it, you won't be able to unsee it. This Dropping Bombs episode with Brad Lee is loaded with those, hold on, why did no one tell me this? Those are the moments. So if you want to make your money work harder than you do, stay right here and let's dive in.
Today in the studio, folks, as always, got a real treat. Chris Naugle's in the house.
Happy to be here.
This dude, money mentor, speaker, author, former pro snowboarder, host of HGTV show something, The Money School. Is it The Money School?
The Money School.
Now, what is The Money School?
Money School teaches people how to take back control of their money by showing them how to be the bank.
See, now what does that mean, be the bank?
So basically we use a system that's been around a while to show people how to do exactly what banks do with money. And they just take back control, change one thing, and that's where their money goes first. Using specially designed and engineered whole life policies is kind of where that all flows into.
So you just bypass the bank, put your money here.
Yes, sir.
And then it pays you, I'm sure.
Yeah, everything that you pay the bank comes back to you. Takes time.
Interesting.
So let's say let's just use 10 grand, simple math, right? You got 10 grand. Now you hear me talk on one of my things and you say, all right, he said change one thing, change where this money goes.
Okay.
Don't put it in somebody else's bank, because we know how a bank works. If you put money in somebody else's bank, let's just use Bank of America for all intents and purposes. How much do they pay you? 1% maybe?
Nothing.
Even at these rates? Yeah, I mean, you're like, no, but let's just call it 1. The bank then takes your money and immediately sends your money out to work for them. They loan that money out.
Yeah, but they have a whole bunch more of it.
They do. But
because what if they sent your money out and you needed it?
If you needed the money back?
Yeah.
That's a unique thing. So if you needed it back, you could go in and you could take it back, because they're not using yours. They're just leveraging your money, okay, through fractional reserve banking. But that's a whole nother topic. But just if you put your money there, you're making nothing. The bank's making 400 to 1,300% more than you are. So if you took the 10 grand and you put it into your bank, which your bank, just to quantify, is a specially designed and engineered whole life. Now, everybody, when they hear that name, I know what they're thinking. Oh, that's the worst place. That's the worst suggestion. And overpriced, expensive. But they don't understand. I'm not talking about the whole life your broke-ass brother-in-law sells you. These are built upside down and backwards. When you put money in these, your money is immediately available in the next 30 days. Maybe not 100%, but up to 90% can be. So you then would take that money out. When you take the money out, you're not taking your money.
It's a loan.
It's a loan. You know how this works. You take a loan. So you're 10 grand still earning a guaranteed interest rate plus dividends, which with most of the companies is between 5 and 6%. You weren't making even 1 in the bank. Now you're making 5 to 6. But you now are holding $9,000 of your 10,000 when you didn't interrupt the compound interest. You take that 9 grand and you go make that money work for you. This is the thing a lot of people miss. It's not about the whole life. It's about what you do next. Take that 9 grand. I know it's not a lot of money, but let's just say you wanted to lend that money. You want to become the bank and lend it out on a real estate deal. So you lend 9 grand out at 12%. That money starts coming back to you in interest payments. Where are you going to put that? Most people put it back in somebody else's bank, but because you've created your own bank, you should take that money and put it back into your bank as a loan repayment. People are like, why would I ever pay myself back? Because every dollar you pay yourself back is the dollar you have to use the next day. Plus you never lost interest on that money because it kept earning. That's what I do in a nutshell.
So people come to a class or what?
Yeah, we have a ton of videos on YouTube. Everything I have is YouTube or on my website. They watch a 90-minute video, teaches the entire concept, shows them how to get all the money back for all the cars they're ever going to buy, drive, and own by changing just one thing. People make it complicated, but it's really simple.
What do they change?
Where the money goes first. Stop putting your savings in somebody else's bank, put it in your own bank, and then learn how to do what a bank does. Learn how to lend money or use your money. Here's an easy way. Like, how many people you know have credit card debt?
Shit, me every month.
Right. But you
like
pay it
I have
off.
to pay the ridiculous amounts of credit card debt off every single month. Otherwise I'd be in stupid debt.
But let's just say you had the intent to pay it off, but for some reason you couldn't.
Then you're screwed.
Right. How much is the credit card going to charge you, Brad?
Dude, you're screwed.
Right.
19%, 16%, 14%. Who knows?
Think of all the people paying 19, 14, 25, 29% interest. Imagine if you just started treating your money the same as you treat the banks, you'd have to have money to save. But even if it wasn't a lot, my first plan that I set up was $240 because that's all I had.
What if you loan it out and someone doesn't pay you back?
Forget about loaning it out.
Money.
We're talking credit cards. Let's take a step back because a lot of people can't get that private lending part. Let's say you just had $500 a month to save. You start putting $500 a month into your banking policy, and then every quarter you take a loan from your policy and you pay down your credit card. Well, now you're paying interest on a lower balance, which means your minimum monthly payment for that credit card just went down. But let's just pretend that minimum monthly payment didn't go down. Let's take the difference and put it back into your bank as a loan repayment to your bank. If you kept doing that quarter after quarter after quarter, your debts would go away. And we got to take one from Dave Ramsey and start snowballing. We got to put debts in order from lowest balance to highest. Because a lot of people want to start with the highest interest rate. That's backwards. You got to do the lowest balance because it's easier to pay a low balance off than a high balance. And then you get that emotional, that euphoria when you pay that card off. So let's just say you had a credit card that was $1,000 and you're paying 15% interest and $100 a month trying to knock it down. You take and put the money, that $1,000 in your bank, you take it out and you pay off the credit card. Now you no longer owe Visa $100 anymore. But what if you took that $100 and instead of not giving it to Visa, you just wrote your name on the check and you paid it back to your bank? It's the equivalent of recapturing 20% or 14 or 15 or whatever the credit card was charging you. So now you're making money twice. People are like, well, how twice? Well, you were giving money away to Visa every month in interest. But remember, your money never left your account.
Well, you wouldn't be giving Visa any money if you paid it off.
That's true, but I'm trying to get you to think like the bank, right? You used to give it to Visa and you never thought anything of it. So now that Visa's paid off, but where'd the money come from? You got to think of it like you're the bank. You take your money from your bank and you paid Visa off. A lot of people are like, well, duh, it was my money to begin with. Stop thinking like that. You got to think like you're the bank and do what the bank does. The $100 you used to give away, just put it back in your account. What's the difference? It's $100 you don't have to spend anymore. So now where's it going to go? Most people would just put it back in their bank, put it in your bank. And now all of a sudden that money is earning interest and you're paying less and less on the loan interest that the insurance company charges you. It's all about a spread. Okay. So every bank makes money by a spread. They pay you 1, they charge 5. They make a 4-point spread. If you're making 6, like one of the policies, and it costs you 4 to borrow the money out of the policy, what's your spread? 2, right? So you're making 2 plus whatever that money makes when you send it out to work. Most people know how to make money once. I know how to make money twice. Listen, don't give me too much. I didn't come up with this.
How long have you been doing it?
Oh, since 2014.
How much money do you have now?
Hundreds and hundreds of thousands in banking policies. I have 9 policies now. But it's not so much the policies that matter. I mean, I don't care about having any money in the policies. I put it in and I send that money out to work, which is...
What if someone has like 5-10 million to set in the bank?
That's perfect. I just had literally just today, one of my clients got approved for 2.55 million. So he's putting 255 in. He's a real estate developer. He's then going to immediately take that money out. Now there's a little different game we played there.
I don't get how you can take it in and take it out. Like, why would they give it to you if you're going to take it right back?
Because they allow it. It's not every insurance company that allows this, but the ones we deal with allow us to put the money in and immediately take that money out. Now you can't take it all. Okay. So if you put
80%?
$1 million in, about 80 to 90% can come out right out of the hole. Okay. But then next year, let's say you put $1 million in and then you can take 900 out and then 900 goes to work.
Well, why couldn't you take the 900 out and then go open another one?
You could, but I don't think you'd do that because that's just not a good use for your money. You could, but why do that? Because then the 900 is only making 6%. Your 900 could go out and make 12% through something like that software company.
So why don't you put your money there instead of there?
Where?
Why would I buy an insurance policy only to take 90% and go make money with it? Why wouldn't I just make money from the $1 million I had in the first place?
You could, but if you make money with the $1 million can only make money once. Imagine if that $1 million changed where it went first and went into the policy first. That money's going to earn interest for the rest of your life, whether or not you keep it in there or take it all out. And every year that money's going to make more interest because it's compounding. A lot of people don't understand compound interest. So if you put $1 million in and it makes 6%, now next year you're compounding on $1 million plus the 6% interest. And the year after, it's compounding again and again and again. So you're always compounding off a higher balance. But your money's
unless you
out
take
there.
it.
No, it doesn't matter. Remember I said, it doesn't matter if you take the money out. When you take the money out, let's just use $1 million for $1 million. You put $1 million in, take $1 million out. How much is left in the insurance policy?
0.
No, $1 million.
Well, again, then that's
so
the part
let me
I
explain
don't get.
that.
Why would an insurance company
So here's the
borrow
thing.
my $1 million for 30 days and then let me take it back and still have the policy.
This is easy. This is where I'm going to drop a bomb. Okay. When the insurance company gives you the $1 million, remember they're giving you a loan, but it's a loan you never have to pay back. Because what did the insurance company promise? You know, life insurance. What's one of the promises life insurance makes?
If you die, we'll pay.
They're going to pay a death benefit when you die. The insurance companies don't say that you have to wait to die to borrow that money. So the insurance company, when they give you that $1 million back, okay, that loan for the $1 million, it's in advance of your death benefit. Your $1 million never leaves your account, never stops earning the interest. They give you $1 million of your death benefit. So if you started with 10 million.
What interest rate? What interest rate?
Did they pay you or charge you?
Charge you.
6 and 4. So, and it's one company.
So
it can be
two.
between 5 and 6, depending on what company we use.
So you net 2.
That's correct. This year. But next year, you're netting more because you're getting a bigger spread because your money's compounding. That 4% never changes.
You're just getting more money. The percentage doesn't change, right?
Percentage doesn't change, but their spread does. Again, you got to think like a
microscopically,
bank.
But yeah.
It doesn't matter. Over time, it happens faster and faster.
Sure it does.
And it's more than what somebody's making now. If you did just the same thing you said, if I had $1 million in the bank and I've taken $1 million and I lend it out at 12%, how much you making? 12. But if I just change where the $1 million goes first, and then I lend it out from there, how much I'm making? 12 plus a spread.
So how does one get qualified for a large policy?
Got to look good on the inside as you do on the outside. Got to be healthy. I mean, you can't.
What factors do they go by?
There's a lot of them. You know, if you had cancer,
resting heart rate.
Yeah, but that's probably not as huge of a factor. If you had serious medical issues in the past, cancer, diabetes, you take insulin, you're not going to get approved. But that doesn't mean it's game over. I mean, look at how banks are the number one purchasers of whole life in the world. The top 5 banks in this country own $75 billion of whole life. It's called BOLI, bank-owned life insurance. So when you really look at that, and if we do all the banks in the country, it's over $1 trillion right now. And people can look up, let's just go to the government website, okay? But if banks are doing this, why isn't everybody else? You know, so banks are an entity. A bank can't get an insurable policy. They can't. What's a bank going to do, right? So if you're an entity, you can't own a policy because there's no insurable interest. There's no life to insure. When you walked into the bank last time you did, how many vice presidents did you see? I
don't walk into banks.
When you did.
Oh, shit. I don't know who was vice president and who wasn't.
Everybody's a vice president. They all got the little tag that says vice president. But nobody ever asks, why does a bank need so many vice presidents? Well, banks need to place tier 1 capital, and it needs to be guaranteed. So they put it in these policies. So to get that insurable interest, they promote their employees to vice presidents. So they have an executive, because the vice president's an executive of the bank. Now the bank's got an insurable interest in that individual, and they can take a policy out. What do they give to the employee for that? They give them a fully paid up policy, 50 or 100 grand. But how much is the policy the bank actually bought? $1 million, $2 million death benefit. Plus the bank can use all the cash.
So what if that vice president dies? Is the bank the beneficiary?
Absolutely.
Rude.
Yeah.
That means the crooked bank could just be whacking people.
They've been doing this. Well, yeah. I mean,
getting rich.
Remember, Walmart was doing this, but they weren't giving their employees anything. They got sued big time. They were taking policies out on all their executives, but they weren't giving their employees anything. And then when one would die, Walmart got a bunch of money from the death benefit. The employee's family got nothing. They got sued. Look it up. It's public knowledge.
That's rude.
That is very rude, but that's business. They know how to make money. Banks are smart.
Business is business. Hey, if you guys don't follow this dude, the Chris Naugle, Naugle, the Chris Naugle, moneyschoolrei.com. Is that your website?
They can just go to chrisnaugle.com. Everything's there.
chrisnaugle.com.